What happens when the cost of housing soars to an all-time high? They crumble to the ground. Because sadly, that is how things actually work. So, there was a significant increase in the cost of housing in 2020, which might not seem like much compared to other assets like stocks, but double-digit growth in real estate is a symptom of a bubble. Hey guys, welcome back to another video here in Capital Finance. We've talked about different investments in our previous videos, such as stocks and dividends. However, we have not tackled deep on the real estate industry. So this video will do just that. Real estate, just like stocks, is a complex system which needs to be studied. So before we begin, please like this video, and let's get right into it. The housing market did not develop overnight in the same way that cryptocurrencies did. In order to keep up with inflation, this well-established market has an annual growth rate of roughly 2%. Despite this, the market collapsed in 2008 as prices rose at a greater rate than in 2007. It was challenging to sit on the sidelines and not take out a mortgage or at least refinance your home because even a 1% change in your mortgage rate might make a tremendous difference. What if, at the end of the year, rates climb 1%? Just how big of a difference does a 1% change in the interest rate make? 1% implies you'll pay an extra $35,935 over the life of your loan if your loan is $200,000. We didn't even account for the opportunity cost, which is the amount the money would have gained if it had been invested. That's a significant sum, in my opinion. When investing in the S&P 500 for 30 years at a 10% return, a 1% difference on a $200,000 loan translates to an extra $239, which equals to $518,000. Consider what would happen if you were to successfully haggle for a lesser price. When you retire, you will have an additional $500,000 in your bank account. That's something to think about, in my opinion. What if you have a $300,000 or $400,000 mortgage? There's a good chance it's much higher. Taking out a 30-year loan for $400,000 will cost you an extra $71,870 in interest, or $477 a month. The opportunity cost comes to $1,035,720 when all is said and done. As a result, the interest rate on your mortgage is the most critical consideration anytime you apply for one. Interest rates were cut to virtually 0% by the Federal Reserve when real estate prices rose dramatically in the middle of a pandemic because everyone eligible for a mortgage took advantage of it. People can no longer afford a house due to rising real estate prices. Yet, mortgage rates were so low that acquiring one still made economic sense. But what will happen when mortgage rates rise? Real estate prices might fall due to a decrease in demand, which is inevitable. We must also take into account the cost of renting a home. For the most part, rent and home prices rise in tandem. However, there have been a few instances where one has outperformed the other, such as in 2020. As a result, some human specialists feel that we are on the verge of repeating the mistakes of 2008. Due to people's inability to keep up with their mortgage payments, the housing market would have collapsed if the Fed had not intervened. The majority of people live paycheck to paycheck, so the only reason they were able to qualify for that mortgage was that they had a consistent source of revenue. Because of the surplus of homes available, prices fell, and the market crashed due to the bank panicking and selling these properties to make up for the missed payments by millions of individuals. That has already happened in the United States. That is why the government urged homeowners to take 1 year off from their mortgage payments, regardless of their ability to afford it. What happens after the tolerance period ends and the economy hasn't fully recovered when people are unable to pay their mortgages due to a lack of financial resources? Finally, the structure will come crashing down. For the simple reason that prices have risen faster in recent history. the public has begun to expect further increases. Speculators are drawn to the market by this anticipation and invest in the hopes of profiting from rising prices. The bubble continues to expand as a result of these factors, and one of these gorgeous days, it will explode. Mortgages were not heavily regulated in 2008. Therefore, banks began to give out loans at will. No, I'm not making light of it, but it really did happen. In the housing boom, mortgage underwriting was so bad that some lenders were sending simple loans. No earnings confirmation, no employment confirmation, nothing. When it came to housing construction in the United States, developers created houses quicker than they could be occupied. It took some time, but finally, prices fell. Individuals defaulted on their mortgages, and the United States economy crumbled, contributing to the global economy's demise. Some of these homeowners were unable to keep up with their mortgage payments as the value of their homes plummeted. They also couldn't recoup their debt by selling their house. When these mortgages were bundled together and sold to investors as securities, banks didn't give a hoot about it. For this reason, lenders called prospective borrowers repeatedly to try to persuade them to take up a mortgage without requesting any supporting evidence. It made reasonable sense after all. Didn't your parents tell you that housing prices would climb forever? The unexpected, on the other hand, occurred. A closer examination of today's housing market reveals a stark contrast to how things were in the early 2000s. There is no mortgage for anyone until they can prove they will be able to repay it. Another interesting fact is that the homeowner vacancy rate is now at 0.9%, the lowest since 1956 in the United States. Rather than oversupply, there are fewer residences available this time around. Prices increase when there is not enough product to go around. The banking industry has been highly regulated since the 2008 catastrophe, making it pointless to keep constructing new homes unless there is a demonstrable demand for them. Everyone had no idea that the Fed would drop interest rates to 0% and mortgage rates would fall to the bare minimum when a pandemic unexpectedly erupted. The first thing I wanted to bring up was the idea of the long-term impact that even a tiny proportion has. Many individuals grabbed at the opportunity to own a home because of this. Even though property prices have increased dramatically, lower monthly mortgage payments attract purchasers. However, the U.S. Department of Agriculture estimates that 1 out of every 10 homeowners have fallen behind on their mortgage payments, putting them at the risk of defaulting on their loans. Even if the forbearance program is not renewed, most homeowners had established considerable equity in their houses to sell them and pay off their debts in full without difficulty, unlike in 2008 when the decrease in prices caught individuals off guard with large mortgages with little to no equity. The future of the real estate market is totally dependent on the Federal Reserve's ability to keep it stable and manage inflation. Interest rates might fall to zero in a deliberate approach by the Fed, resulting in only a slowing of price growth or perhaps an increase. There won't be a crash, though. Understanding the real estate market is important since it's not like stocks, which rise and fall constantly. Even if anything like a crash is imminent, it's unlikely to happen this year in this well-established market. Neither I nor anyone else can predict the future. It's hard to believe that another one may be on the horizon less than 2 decades after the last real estate catastrophe. If you have a mortgage and haven't refinanced yet, you're losing out on the best thing you can hope for, a low fixed rate for 30 years. In the long term, even those who didn't sell their homes back then will be alright if they get a cheap, fixed 30-year mortgage rate. Just make sure that when you take out a mortgage that you had done enough research and calculations so that you can make the most out of it. So folks, thanks for watching this entire video. Don't forget to subscribe to this channel for more videos like this. See you next time.